Here is your 500-word intro in MarkDouglas style psychology without mentioning him as requested. And with no ending phrases. #Intraday. The safest way of trading. The safest way to approach intraday trading begins with a shift in how you perceive the market. Most traders enter the day searching for certainty. Certainty of direction, certainty of outcome, certainty that the market will reward them for simply showing up. But intraday trading does not offer certainty, it offers opportunity. And opportunity only becomes safe when you learn to align your mindset with the market's ever-changing structure. Safety in intraday trading is not created by avoiding risk, it is created by mastering your relationship with it. Every moment in the market is unique. No pattern, no setup, no candle, no indicator will ever be identical to the one you saw yesterday. And yet the majority of traders treat the market as if it is obligated to repeat itself precisely. This creates tension, expectation, and fear. The safest intraday trader is not the one who waits for the perfect setup, but the one who has learned to operate without needing certainty, trusting their process and responding to the market instead of trying to control it. Intraday safety comes from clarity. Clarity of rules, clarity of risk parameters, clarity of what you expect from the market and what the market expects from you. When you approach the day with a defined structure, you are no longer at the mercy of impulses or emotional reactions. You are operating from a position of strength. The market becomes a place where probabilities unfold, not a battlefield where you fight your own doubts. To trade intraday safely, you must learn to detach from the outcome of any single trade. This is where most traders struggle. They cling to each trade as if it defines their skill, their worth, their future. But the safest trader accepts that any trade can lose and any trade can win. There is no emotional swing, no panic, no attachment. There is simply execution. This detachment frees your mind from pressure and opens the door to consistent decision-making. Another aspect of intraday safety is understanding that the market offers limited windows of high probability movement. Your job is not to chase every candle or respond to every fluctuation. Your job is to wait, observe, and recognize when the market is aligned with your plan. Safety is created by selective participation, choosing when to act and when to stand aside. Most traders do the opposite. They act the most when conditions are the worst and hesitate when conditions are the best. The safest intraday trader respects risk as the cost of doing business. They do not argue with the market, they do not average down out of fear, and they do not widen stops to protect their ego. They understand that losing small is the foundation of winning big. Safety is a product of discipline, and discipline is the result of consistent mental rehearsal, training your mind to think in probabilities, not certainties. Ultimately, intraday trading becomes the safest form of trading when you build a psychological framework that supports consistency. The market rewards the traders who accept uncertainty, think in probabilities, follow their rules with absolute clarity, and act without hesitation. Intraday trading is not about predicting the market. It is about preparing yourself to flow with it, moment by moment, without fear, without emotional conflict, and without the need for certainty. Trading based on probabilities rather than certainty begins with understanding the true nature of the market. The market is not a place where predictions guarantee outcomes. It is a dynamic environment driven by countless variables that you will never fully know or control. Every price movement, every shift in momentum, every breakout or reversal is influenced by a mix of visible and invisible forces. To approach trading with the expectation of certainty is to place yourself in direct conflict with an environment that does not care about your desires, your analysis, or your need to be right. When you trade with the mindset of seeking certainty, you create internal pressure that leads to emotional decision-making, hesitation, fear, and frustration. Trading based on probabilities frees you from this pressure by allowing you to operate with a mindset fully aligned with the real nature of the market. Probabilities acknowledge that the outcome of any individual trade is uncertain, but across a series of trades following the same rules, patterns, and conditions, the edge you use will express itself. This shift in thinking transforms how you experience wins and losses. A loss is no longer a personal failure. It is simply part of the distribution of outcomes that your edge produces. A winner is not validation of your skill. It is only one piece within a larger sequence. The trader who thinks in probabilities does not attach identity or emotional weight to each result. Instead, they view every trade as a random outcome of a repeatable process. This frame of mind reduces emotional volatility and allows for clearer decision-making. Most traders fail because they treat each trade as a unique event that must work. They expect the market to follow their analysis, and when it doesn't, they experience emotional conflict. A trader operating from a probability mindset removes this conflict before it appears. They understand that a valid setup can still fail, that a perfect entry can still lead to a loss, and that no amount of analysis can guarantee the result. This acceptance creates a mental environment where execution becomes smooth, objective, and free from anxiety. You do not hesitate, you do not doubt, and you do not force trades that aren't there. You simply execute your edge every time it appears, knowing that the long-term results will take care of themselves. When you think in probabilities, you structure your trading process around consistency rather than prediction. Instead of trying to anticipate what the market will do next, you focus on recognizing conditions that historically offer a favorable chance of movement in your direction. You are not attempting to foresee the future. You are aligning yourself with the most likely outcomes based on your predefined rules. This shift in focus allows you to remain stable even during periods of market uncertainty, where others freeze, overreact, or chase price. You remain composed because you understand that no single outcome has the power to influence your long-term trajectory. A probability thinker also treats risk in a completely different manner from a trader seeking certainty. Instead of risking too much on trades they believe should work, they risk a consistent, predetermined percentage based on the recognition that losses are unavoidable. This makes risk feel less threatening because it is always controlled and never emotional. Knowing that a losing trade is simply part of the distribution frees you from the fear of being wrong. That freedom gives you the ability to act decisively without hesitation. Traders who hesitate lose opportunities because they are mentally trying to avoid pain. Traders who think in probabilities act because they have already accepted that both outcomes are possible and acceptable. The probability-based trader also evaluates their performance from a macro perspective. They do not judge their skill based on one day, 1 week, or even 1 month. Their focus is on the long-term expression of their edge. This prevents emotional swings based on short-term outcomes. A losing day doesn't shake them, and a winning day doesn't inflate them. They remain stable, grounded, and focused on process over outcome. The safer and more consistent your emotional state is, the more accurately you can execute your plan. Thinking in probabilities becomes a psychological advantage because it removes the emotional noise that disrupts trading decisions. In the moment-to-moment flow of the market, thinking in probabilities creates mental space. You are no longer fighting for confirmation or searching for reasons to believe your trade is right. You observe the market openly, without bias. When a trade aligns with your edge, you take it. When it doesn't, you stand aside. This simplicity and clarity allow you to conserve emotional energy and maintain focus throughout the trading session. You are not constantly battling your own expectations or trying to impose your beliefs on the market. Instead, you are in alignment with what the market is actually doing. This mindset also changes how you respond to unexpected moves. Traders seeking certainty often panic when the market behaves differently from their analysis. They freeze, widen stops, add to losing positions, or close trades prematurely. In contrast, the trader who thinks in probabilities remains calm because they never expected certainty in the first place. When the market moves against them, it is simply information, not a threat. They exit according to their rules and move on without emotional residue. This ability to remain unaffected by unexpected outcomes is one of the greatest advantages of probability-based thinking. Thinking in probabilities also enhances your ability to adapt. Since you are not fixated on being right, you are more open to new information and shifts in market structure. You can adjust your outlook when conditions change because your identity is not tied to your original analysis. You become flexible, responsive, and capable of flowing with the market rather than resisting it. Adaptability is one of the highest forms of trading intelligence, and it emerges naturally from a probability-based mindset. A probability thinker also knows the importance of sample size. 1 trade tells you nothing. 10 trades tell you little, but 100 trades under the same conditions reveal the true strength of your edge. This perspective keeps you from overreacting to short-term results. You don't abandon your plan because of a losing streak, nor do you become reckless because of a winning streak. Your confidence comes from statistical understanding rather than emotional fluctuations. This creates a level of psychological stability that the average trader never reaches. Lastly, thinking in probabilities allows you to operate with genuine detachment. You are not trading to prove anything. You are not trading to avoid being wrong. You are not trading to satisfy your ego. You are trading because you trust your edge and the long-term distribution of outcomes it produces. Every trade becomes a neutral event, and neutrality is the doorway to consistent execution, emotional stability, and long-term success. Following a clear and repeatable intraday plan begins with the recognition that structure is the foundation of consistency. Without structure, trading becomes a series of emotional reactions to price movement. Most traders enter the market every day without a fixed plan, believing they can adapt on the fly, respond intuitively, or rely on quick judgment. But intraday trading unfolds too quickly for improvisation. The speed of price movement, the emotional intensity of real-time decisions, and the constant pressure of uncertainty make it impossible to remain consistent without predetermined rules. A clear plan eliminates confusion, minimizes hesitation, and reduces emotional interference by defining exactly what you will do long before the market opens. A repeatable intraday plan is not merely a list of setups or indicators. It is a complete framework that governs your behavior from the moment you sit at your desk to the moment you close your platform. It defines your entry conditions, your risk parameters, your position sizing, your management rules, and the exact circumstances under which you will exit a trade. The purpose of this structure is not to predict the market, but to guide your actions in the presence of uncertainty. With a plan, you never enter the market blindly. You act with intention, clarity, and confidence, because you know precisely what qualifies as a trade and what does not. When traders lack a plan, they are forced to create decisions in real time. This is where fear, greed, hope, and impatience take over. Without predetermined rules, the mind searches for certainty, and when certainty cannot be found, it constructs emotional narratives that distort perception. A strong push candle suddenly looks like a breakout, even if it's against your bias. A pullback feels like a reversal because you want a better entry. Noise begins to look like opportunity because you feel bored or anxious. A plan protects you from these illusions by giving you a fixed lens through which to interpret market behavior. A repeatable plan also simplifies your daily routine. Every day starts with the same checklist: identify market structure, define key levels, establish bias, determine high probability time windows, and prepare for scenarios. The more mechanical your preparation becomes, the more mental space you free up for execution. A trader without structure uses energy trying to figure out what to do. A trader with structure conserves energy for doing what matters, executing the plan when the market aligns with it. One of the greatest benefits of a clear plan is that it transforms your trading into a process that can be measured and improved. When your behavior is consistent, your results become consistent, and consistent results can be analyzed objectively. You can identify what works, what doesn't, where your edge lies, and where your weaknesses appear. Without a repeatable plan, every trade becomes unique, untrackable, and impossible to evaluate. Improvement becomes random because the data you produce is random. A repeatable plan turns your trading into a controlled experiment where variables remain stable and performance can be optimized over time. Another important element of a repeatable plan is that it removes the burden of constant decision-making. Decision-making is one of the most mentally exhausting parts of trading. Every choice carries emotional weight, especially when money is involved. But when the majority of decisions are predetermined by your plan, your emotional load decreases dramatically. You are no longer deciding whether to enter or exit based on feelings. You are following instructions you created when your mind was clear, logical, and objective. This reduces hesitation, increases confidence, and prevents emotional contamination of your choices. A clear plan also acts as a filter. It prevents you from taking impulsive trades that do not match your edge. Many traders lose more money from overtrading than from bad setups. They chase price because they fear missing out, or they take trades outside their rules because the market looks like it might move. A repeatable plan eliminates these moments by defining exactly what a valid trade looks like. If the conditions aren't met, the trade doesn't exist. The clarity of these boundaries keeps you disciplined and focused on quality rather than quantity. The structure of a repeatable plan also helps regulate your emotional state. When you know what to expect, uncertainty becomes manageable. When you know what triggers your entries and exits, stress decreases. When you know the maximum you can lose on a trade, fear softens. A plan doesn't eliminate uncertainty, but it gives uncertainty a container, making it easier to navigate. The mind performs best when it has a roadmap, and a trading plan is that roadmap. A repeatable plan also gives meaning to patience. Without a plan, waiting feels like doing nothing. With a plan, waiting is execution. You are not wasting time. You are allowing the market to align with your criteria. This shift in mindset reduces the urge to chase trades and makes it easier to sit through quiet periods without losing focus. Patience becomes purposeful rather than forced. Following a clear intraday plan also aligns your actions with your long-term goals. Most traders say they want consistency, but their behavior reflects the opposite. They change strategies frequently, alter rules mid-trade, or respond emotionally to market noise. A plan anchors you to the behaviors required for long-term success. It forces you to remain aligned with a repeatable process instead of being pulled into randomness by momentary emotions. The more you follow your plan, the more trust you build in yourself. Confidence in trading doesn't come from wins, it comes from consistency. Every time you execute your plan correctly, regardless of outcome, you reinforce discipline. Every time you deviate, you weaken it. This internal trust is one of the most important psychological assets a trader can develop. When you trust yourself to follow your rules, trading becomes lighter, calmer, and more controllable. A repeatable intraday plan also protects you from market manipulation, volatility spikes, news reactions, and fake breakouts. Because the plan tells you when to stand aside as clearly as it tells you when to enter, you avoid the dangerous periods most traders get trapped in. You no longer react emotionally to sudden movements because your plan has already defined when you will and will not participate. Clarity brings freedom, and repeatability brings control. Together, they create the foundation for safe, disciplined, and consistent intraday trading. Maintaining emotional neutrality on every trade begins with recognizing that the market does not create your emotions, your interpretations do. Price movement is neutral. It has no agenda, no intention, and no awareness of your presence. Yet traders constantly react as if the market is personally rewarding or punishing them. This illusion is the root of emotional instability. Emotional neutrality comes from stripping away those personal meanings and seeing market movement as nothing more than information. When you separate your identity from the outcome of each trade, the emotional weight disappears and clarity replaces tension. Most traders experience emotional volatility because they enter trades with hidden expectations. They want to be right, they want the trade to work, and they want the market to validate their analysis. These expectations create a subtle internal pressure that makes them emotionally vulnerable. When the market moves in their favor, they feel excitement. When it moves against them, they feel fear or frustration. Neutrality means eliminating the desire for the market to behave in any particular way. You act based on your rules, and whatever the market does next is accepted without resistance. When the need for a specific outcome disappears, emotional swings fade naturally. Emotional neutrality also comes from accepting uncertainty as the permanent backdrop of trading. Traders struggle because they unconsciously resist uncertainty. They want control in a place where control does not exist. They want predictability in a place governed by randomness. They want guarantees when the market offers none. This resistance creates anxiety, tension, and internal conflict. When you embrace uncertainty as an unchangeable fact, your mind relaxes. You no longer fight the environment, you flow with it. Neutrality becomes easier when you stop demanding certainty from a system built on probabilities. A critical part of emotional neutrality is redefining what a loss means. Traders who fear losses don't fear money leaving, they fear what the loss represents to them. To many, a losing trade means inadequacy, incompetence, or failure. This belief turns losing into a psychological threat rather than a statistical event. Neutral traders view losses as expected occurrences within the distribution of outcomes. They don't personalize them, and because of that, losses do not generate emotional disruption. The moment you stop equating losing with being wrong, neutrality becomes achievable. A loss becomes data, not a judgment. Emotional neutrality grows stronger when your focus shifts from outcomes to execution. You cannot control whether the market goes up or down. You cannot control whether a setup wins or loses. But you can control how precisely you follow your rules. When execution becomes the measure of success, your emotional state stabilizes. You no longer ride emotional highs after wins or sink into emotional lows after losses. Your internal evaluation system becomes objective. This objectivity is the soil in which neutrality thrives. Risk acceptance is another cornerstone of emotional neutrality. You cannot maintain a calm mindset if you are risking money that feels significant or threatening. When the risk is too large, Every tick generates emotional reactions. Fear rises because your mind is trying to protect you from perceived danger. The neutral state only emerges when the risk feels acceptable before entering the trade. When you mentally accept the outcome fully, win or lose, the trade no longer holds emotional power over you. Your mind becomes quiet and you trade from a place of balance instead of fear. Neutrality also requires the ability to reset mentally between trades. Many traders let the emotional imprint of the previous trade influence the next one. A winning trade may cause overconfidence, making the trader reckless. A losing trade may cause hesitation, making the trader passive. Neutral traders treat every trade as an isolated event. They do not carry emotional residue forward. This psychological reset allows them to remain balanced, avoiding emotional momentum that can distort perception and behavior. Observing your emotions without reacting to them is another essential component of neutrality. Emotional neutrality does not mean you feel nothing. It means your emotions do not influence your decisions. You may feel tension or excitement, but you act according to your rules, not according to your impulses. This level of internal discipline comes from awareness, practice, and repetition. Over time, your emotional triggers lose their power because your decision-making process no longer depends on them. A neutral trader perceives the market clearly. Emotional traders see what they want to see. They interpret charts through the filter of their hopes and fears. This distorts information and leads to poor decisions. A neutral trader, however, reads the market as it is, not as they want it to be. They do not ignore invalidation signals, they do not force trades, and they do not justify weak setups emotionally. This clarity leads to precision, and precision leads to consistency. Emotional neutrality also prevents extreme psychological reactions. Traders who tie their self-worth to their results will always experience dramatic emotional swings. Neutral traders remain steady regardless of outcomes. A win does not inflate their ego, and a loss does not damage their confidence. Their internal environment stays stable. This stability allows them to make rational decisions even under pressure. Since trading inherently involves stress, a stable emotional center becomes a major competitive advantage. Neutrality enhances patience as well. Many traders act prematurely because they feel internal pressure to do something. This pressure often comes from fear of missing out, boredom, or emotional discomfort during an activity. A neutral trader feels none of this pressure. They wait naturally, comfortably, and intentionally for their setup to appear. They understand that waiting is a form of execution, not a lack of action. This patience leads to higher quality trades and fewer emotional mistakes. Drawdowns are another area where neutrality becomes essential. Emotional traders perceive drawdowns as dangerous periods and panic, change strategies, or take revenge trades. Neutral traders see drawdowns as a normal expression of statistical variance. There is no panic, no desperation, no emotional collapse. This acceptance prevents the destructive behaviors that ruin entire accounts during emotional downturns. Emotional neutrality builds psychological resilience. When the market becomes fast, unpredictable, or aggressive, a neutral trader remains calm and grounded. They can manage sudden moves without emotional imbalance. They can exit quickly when needed and re-enter without hesitation when conditions align again. Their actions remain consistent because their internal state does not fluctuate with the market. As neutrality strengthens, your entire trading experience transforms. You act without hesitation, you follow your rules without internal resistance, you take losses without emotional pain, and you let winners unfold without fear. You read the market clearly, execute cleanly, and remain stable regardless of outcome. This internal stillness becomes the foundation of consistent performance, and consistent performance becomes the foundation of long-term trading success. Protecting capital through strict risk control begins with understanding that trading is not about how much you can make, but how much you can keep. The market rewards those who survive long enough for their edge to play out, and survival is impossible without disciplined risk management. Many traders approach the market with the mindset of maximizing profit, yet they overlook the fact that consistent profitability is built on limiting exposure, preserving account balance, and ensuring that no single trade or series of trades can cause irreversible damage. Risk control is not a secondary skill, it is the core principle that keeps you in the game long enough to develop every other trading ability. Strict risk control starts with accepting that losses are inevitable. No strategy, no analysis, and no amount of experience can remove the inherent randomness in market behavior. The trader who resists this truth will continually risk more than they should, trying to create certainty where none exists. The trader who embraces it understands that every trade carries the possibility of loss, and therefore structures each position with the expectation that the worst-case scenario must be fully acceptable. Risk control becomes the psychological shield that prevents emotional devastation when the market does something unexpected. One of the most important components of risk control is position sizing. Position sizing determines how much of your capital is exposed to any single trade. Traders often make the mistake of increasing size based on excitement, intuition, or recent wins. This emotional sizing creates vulnerability because larger positions amplify emotional reactions and magnify losses. A strict risk approach uses consistent sizing based on a fixed percentage of capital so that each trade carries an acceptable level of risk. This consistency forms the foundation of emotional stability because when you know exactly how much you can lose, fear loses its power. Another key aspect of risk control is using predetermined stop losses. A stop loss is more than a protective tool. It is a boundary that preserves your psychological state. Without a stop loss, a losing trade becomes a burden on the mind. You watch it move against you, hoping it will reverse, fearing it will get worse. This emotional conflict grows heavier with each tick. A strict stop loss eliminates this conflict by providing a clear exit point determined when you are calm, rational, and objective. Once the stop is set, your responsibility is simply to respect it. This creates mental freedom and prevents small losses from turning into catastrophic ones. Protecting capital also requires avoiding trades that fall outside your defined criteria. Many traders lose money not because their edge is weak, but because they take trades that never met the criteria of their edge in the first place. Boredom, impatience, fear of missing out, and the desire to be active push them into unnecessary decisions. Strict risk control means filtering opportunities so thoroughly that only clean, valid, high-probability setups qualify. Every trade must be intentional, not emotional. Limiting the number of trades reduces risk exposure and increases the quality of decision-making. Capital protection is also deeply connected to emotional control. When a trader risks too much, emotions naturally intensify. The fear of losing a significant portion of capital makes even small movements feel threatening. Emotional stress then clouds judgment, causing premature exits, poor entries, revenge trades, and impulsive behavior. Risk control solves this problem at the root. When the risk is always small and controlled, emotions never escalate to dangerous levels. This emotional stability is one of the most powerful benefits of strict risk management. Another essential element is understanding the difference between good and bad losses. A good loss follows your rules. It is kept small because your risk parameters were respected. A bad loss breaks your rules, often because of hesitation, hope, or the refusal to exit. Strict risk control eliminates bad losses by maintaining rule-based discipline. When every loss you take is a controlled one, your account remains stable and your confidence remains intact. Good losses are simply part of doing business in a probabilistic environment. Risk control also helps resist the temptation of over-leveraging. Leverage amplifies both profit and loss, and for the unprepared trader, it is a trap disguised as opportunity. The allure of large gains creates psychological blindness to the devastating consequences of oversized exposure. Strict risk control treats leverage as a tool, not a shortcut. When used responsibly, it enhances your edge. When used recklessly, it destroys it. Controlling leverage ensures that your capital remains protected even when trades move sharply or unexpectedly against you. Capital protection has another important dimension: staying out of the market during high-risk conditions. Not every moment is safe for trading. News events, extreme volatility spikes, unpredictable sessions, and unclear market conditions all present unnecessary danger. Strict risk control includes the discipline to stand aside when conditions are not aligned with your edge. Doing nothing becomes a strategic action, not a passive one. Protecting capital often means protecting yourself from the need to always be involved. Another layer of risk control is managing winners responsibly. Many traders think risk management applies only to losses, but uncontrolled winning trades can create emotional shifts that later lead to poor decisions. Winning can lead to greed, greed leads to overconfidence, and overconfidence leads to increased risk-taking. Strict risk control prevents this psychological drift by defining how to scale out, move stops, or hold positions based on rules instead of emotions. By maintaining structure during wins, you create consistency during the most vulnerable psychological moments. Risk control also builds longevity. The trader who takes massive risks may profit quickly, but they also burn out quickly. Large emotional swings, aggressive exposure, and inconsistent decision-making drain mental energy and create instability. Strict risk control preserves not just capital but mental capacity. It prevents emotional exhaustion and creates a sustainable environment where the trader can operate daily without emotional collapse. Consistency requires a stable internal system, and risk control is the anchor of that stability. Protecting capital shapes your identity as a trader. You stop being someone who chases big wins, and you become someone who prioritizes survival, longevity, and disciplined growth. This identity builds confidence because you know that no single trade can take you out of the game. You become harder to shake, harder to influence emotionally, and harder to break psychologically. Risk control becomes part of your trading personality, creating a mindset that can withstand uncertainty, volatility, and randomness without falling into emotional extremes. High probability market conditions are not about finding certainty, but about recognizing moments where the odds lean meaningfully in your favor. Every intraday trader faces the same reality. The market is constantly shifting, constantly redistributing opportunities, constantly creating and erasing advantages within minutes. What separates consistently profitable traders from everyone else is not a secret setup or a perfect indicator, but the ability to identify conditions where the market, structure, rhythm, and momentum align in a way that increases the likelihood of a successful outcome. These conditions are not permanent, and they don't appear at random. They form when the collective behavior of buyers and sellers becomes more predictable because it organizes itself around repeating patterns of order flow, volatility, and direction. Your job is to recognize those moments with clarity, neutrality, and discipline. Rather than projecting your desires onto the chart or assuming that the market owes you a trade simply because you want one. When you restrict yourself to trading only during high probability conditions, you automatically filter out the noise, the emotional impulses, the low quality setups, and the situations where randomness dominates. Many traders lose not because they lack skill, but because they participate in environments where the market isn't ready to move. They trade in chop, in indecision, in hesitation, in ranges that lack momentum, in structures that don't yet have a directional preference. When you operate this way, the outcome of your trade is far more dependent on luck than on skill. By contrast, high probability conditions narrow the range of possible outcomes. They don't eliminate risk, but they create a more favorable dynamic because the market is behaving in a consistent, readable way. This allows you to align your actions with the flow of the market rather than fighting against it. The essence of these conditions is alignment, price structure, volume behavior, momentum dynamics, volatility expansion, and time of day tendencies begin to converge, creating a moment where the market reveals a temporary bias. For example, a strong trend forming after a clear consolidation is not the same as a random breakout attempt in the middle of indecision. A pullback accompanied by declining volume shows something very different from a pullback filled with aggressive counterflow. A reversal occurring at a major intraday level is fundamentally different from one that emerges randomly. These distinctions matter because they reflect the underlying psychology of market participants. When buyers and sellers agree, even temporarily, on direction, the market moves more cleanly, more efficiently, and with fewer contradictory signals. This is the environment where your strategies have space to perform because you're operating within a framework that supports your trades instead of undermining them. Recognizing high probability conditions requires presence, patience, and a willingness to wait. Most traders fail here because waiting feels uncomfortable. The mind pushes for action, looking for reasons to justify participation so it doesn't feel left out. But the market doesn't reward motion, it rewards alignment with opportunity. When you wait for high probability moments, you're not being passive, you're exercising control over your engagement with the market. You're choosing to participate only when the environment supports your edge. You're creating the conditions for consistency because you're making decisions rooted in structure rather than impulse. This is why the most experienced traders might only take a few trades per session. They understand that the quality of the conditions determines the quality of the outcome. Intraday timing plays a particularly important role. Certain periods of the trading day naturally produce higher quality conditions because that's when liquidity surges, volatility expands, or institutions execute large orders. The open often brings directional conviction. The midday session can bring slower consolidations that set up later moves. The final hour can create momentum bursts driven by positioning. Understanding these rhythms helps you anticipate where and when the market is more likely to provide clean opportunities. When you combine this timing awareness with structural analysis, your ability to spot high probability conditions increases dramatically. Volume also acts as a core component of probability. The market becomes more predictable when participation increases because it takes more effort to reverse direction. A trend with strong, consistent volume behind it reflects commitment. A breakout with rising volume suggests genuine interest, not just a temporary push. Low volume moves, on the other hand, are easily disrupted because there is little conviction behind them. By waiting for moments where volume supports the price behavior you are observing, you reduce the risk of entering trades built on weak foundations. Volatility tells you whether the market is ready to move at all. When volatility is too low, price often drifts aimlessly, producing setups that appear clean but never follow through. When volatility is too high, noise increases and risk expands, making entries less predictable. High probability moments often emerge when volatility transitions from contraction to expansion. This shift creates the conditions for directional movement and follow-through. Recognizing the early signs of expansion, tighter ranges, decreasing wicks, increasing order flow pressure, can position you ahead of the surge. Market structure is the final core element. A clear series of higher highs and higher lows is fundamentally different from a choppy range where direction continually shifts. High probability conditions appear when structure shows consistency, when levels hold cleanly, when pullbacks respect trend dynamics, when breakouts occur after controlled compression rather than chaotic behavior. Structure tells you whether the market has a current narrative or is still searching for one. When you combine structure, volume, momentum, volatility, and timing, you create a filter that protects you from randomness. You begin to see that most of the market's movements are confusing not because you lack knowledge, but because the conditions themselves are low probability. By choosing to engage only when the market aligns across multiple factors, you minimize unnecessary losses and maximize the impact of your edge. This approach transforms your intraday trading from a reactive struggle into a deliberate process rooted in observation, patience, and respect for the market's natural rhythm.